3, 2, 1. All right. What's up, guys? What's up, Evgueni? So thank you so much for coming. I appreciate it.
Thanks for having me.
Evgueni reached out to me and kind of wanted to do this podcast, and I was super open to it because he said that he wanted to go into the different issues that most people are facing nowadays in terms of, getting an approval of their mortgage. So Evgueni is a mortgage specialist, and I'll kind of give you the chance to introduce yourself and kind of give your background before we start. So if you want to just take over
Yeah, absolutely.
You can go ahead.
So currently I work as a mobile mortgage specialist for Scotiabank. I've been doing it for close to a year now, but prior to that I was working for TD, also in mortgages, but as a personal advisor. So I did everything from investments for big clients to mortgages to both businesses and everyday people.
Okay.
I really decided to go mobile because with this whole pandemic and just general what's happening in the world, it's a lot easier, right? I can do things directly by email, over the phone. Sometimes I never even meet the client, and we do a mortgage within a span of a week, rather than at a branch can take up to 2-3 weeks to do the same thing.
Things are more efficient nowadays.
A lot more efficient.
Yeah,
absolutely.
That's good. I'm glad to hear that. And can you give us an idea of, in terms of years, how long you've been in the game? You said that you're now mobile, and before you were TD.
Yeah,
so in total, how many years, for example, you've been in the finance?
In the banking, I've been 5 years now.
5 years. All right. So my man knows what he's talking about. All right. So listen up. Okay. Well, Evgueni, to jump right into it.
Yeah.
What I wanted to ask you off the bat is something that I'm kind of curious on, and I wanted to clarify. And I think most people are gonna get some value by knowing this. There's a pre-approval, and then there's a final, approval for the financing of the mortgage. Can you kind of explain to us when either an or comes into play in the whole real estate transaction,
Absolutely.
and what's the difference between both?
Yeah, absolutely. So a pre-approval is the very first thing you should do when you even think of buying a home.
Okay.
The pre-approval, what it does, in essence, is you come and see me, you give me all your income documents, I check how much debt you have, how much money you make, and I'll tell you, okay, this is how much you can afford. Okay, you take that number, you contact your real estate agent and say, okay, I want to buy a home, and this is my budget, and you use the number I gave you. The issue with most people is they don't do that first step. So they go see their agent, they look at 10 different houses, and then they make an offer, and surprise, surprise, it's way over their budget, right? I would say 9 times out of 10, people go for a lot more that they can afford rather than going for less.
Okay.
Because there's a lot of rules, especially in Canada, where you have to do things like the stress test, which most people don't know about. The stress test is the government says, okay, your rate right now is, let's say, 2%, 2% interest rate. But when you qualify, you have to go for a rate of 4.95 or 4.75. Why? Because they want to make sure if the rate goes up, you can still afford your mortgage, right? Well, people don't know that because it's not the same monthly payments at a rate of over 4% rather than 2%, right? So even though on paper you could afford it, in real life you really can't. Right?
Okay, so it's kind of like a margin of error kind of
exactly
that is applied on your interest rate.
Exactly. So when the bank just qualifies you, you have to use a way higher interest rate than your real one to make sure that you can still afford it in case there's some kind of economical recession and things like that.
All right, that makes a lot of sense.
So the pre-approval is the very, very first step you have to do always before you go looking house shopping or going to even to open houses. Now with the market, what's happening, it's so insane, right? Everyone has like 10 different offers per property that people don't even let you visit without a pre-approval. Because if you don't have a pre-approval, we don't know if you're serious, right?
Yeah.
If you're a seller and you get, let's say, an offer with a pre-approval, it shows, okay, this guy will almost for sure get approved for that mortgage. If you get the same offer with no pre-approval, you don't know what's behind it, right? You don't know if that's a person who has actually.
You don't know how credible it is at the end of the day. That's why a lot of agents, whenever you're gonna contact them because you're curious about buying a home, the first thing they're gonna ask you is, are you pre-approved? Or they're gonna send you over to somebody in order to get pre-approved, because as you said, in our market right now, if you don't have a pre-approval, your chances of even, kind of standing out in those 10, 11, 15 offers are so slim because everybody's pre-approved and everybody's, offering over asking price. So it's tough and it's competitive right now. So getting a pre-approval definitely the first step, and it's necessary right now.
Absolutely, and there's a lot of advantages to it. Not only that you know your budget, but you can actually hold your rate for up to 4 months. So let's say right now there's very low rates. You do a pre-approval right now. If you find a home in 3 months and the rate is a lot higher in 3 months, let's say, you still have your rate locked in, and you'll get either the better rate that's on that day or the rate you already locked in.
Okay, that makes sense.
So for the customer, it's much better as well because they know for sure they'll get a good deal.
Okay, and then so that being said, at what point does the final approval come into play, and what does that mean for the client?
So what you get, a letter of pre-approval, what you get is it says the rate you locked in, the amount you qualified in, but the address, it says to be determined because we don't know what property you're going to buy, right? A final approval is once you have an accepted offer, we can put in, the actual taxes, not just the approximation, but the actual taxes on the property, condo fees if it's a condo, and just dimensions of the property. We get the full detail of what you're buying, and then we get you a letter of final approval, which means that for that specific property, you're approved and we're willing to give you the mortgage. So it goes from just general, here's your budget, to for that property with that address, you're qualified.
So is there any way that the amount that you qualify for your pre-approval differs from your final approval?
Absolutely, because when we do pre-approval, we just do approximation, right? So for example,
it's not as in-depth?
It's not as in-depth because we don't know what exactly we're buying. Let's say for property taxes, right? For pre-approval, you use 1% of the purchase price, okay? So let's say you're buying for $300,000, we have to use $3,000 as taxes, right? However, if you look at the different cities around Montreal, let's say you go to Côte-Saint-Luc or Hampstead, a property there will have much higher taxes for the same value of property, let's say in Longueuil. It's going to be half of it, right? So of course, if you're buying a property in Hampstead and for the same $300,000, your tax on now $4,000 or $5,000, well, you're not going to qualify the same amount. That's why you have to be careful. Once you find a home you like, send me an email. Okay, here's the home. Can you check that this matches well with my pre-approval? And I'll say, okay, yeah, just watch out. Maybe we have to reduce a little bit.
So following that logic, it would make sense to say that most issues arise at the final approval and not at the pre-approval. Is that correct?
Absolutely, because people also change their mind a lot. They call me for the pre-approval. They say, okay, I want to buy a home. I say, no problem. That means I don't count condo fees, right? After looking for months in the market, they realize they don't like any homes. They decide to buy a condo. A condo downtown has $300, $400 per month condo fees, which again is going to reduce his purchasing power. So then his pre-approval is pretty much non-valid because it's not the same qualifications anymore.
Okay. So what would you recommend somebody in terms of a client that comes to you because he wants to buy a house, he gets a pre-approval in order to make sure the transaction runs as smoothly as possible, because there are different facets and aspects to a real estate transaction, and sometimes it can get complicated. What would you recommend they do to make it as simple as possible? What's something to keep in mind? What are some... Sorry.
Yeah, good turn it off.
No problem. Business doesn't sleep, huh?
Exactly.
That's it. So what would you recommend to make sure that it goes as smoothly as possible?
Yeah, so as smooth as possible, first thing you do, you get pre-approval. As we discussed, that's the first step. You have to do it. Once you start shopping for houses, let's say you're about to make an offer on a property. You just send me a quick email. You say, okay, look at this house. Just send me the listing, right? I can see the tax and everything on it. I'll just do quick calculations on my computer. It's not going to be a full pre-approval again, but I'll tell you, okay, yeah, this matches very well with what we pre-approved through. You can go ahead and make the offer. This way you already know that, okay, I'm pretty much certain to get approved for the final approval because there's no changes to what we did before. And also the most important is to not delay with the documents, okay? What happens is once the file is approved, it takes sometimes forever for the agent or the customer to send me the last documents, right? Because I need to know, again, the listings, I need to know the seller's declaration. There's a few extra documents I need to get, And usually with this current market, you have 10 days or 15 days to get the final approval. We have no time to waste, right? So as soon as you get the final approval, you have an accepted offer, you send me all of the documents. This way I can get you the final approval as soon as possible.
Okay, that's interesting. You said that as soon as you find a house that you're pretty much interested in, you think you're going to make an offer on it, contact you and you'll
Absolutely.
make a quick evaluation to make sure it's still good compared to your pre-approval. And is that something that most mortgage brokers do, or is that something that
honestly most don't?
They won't waste their time until there's not a promise of purchase.
Exactly, and that's another thing it's good that you mentioned that, is that a lot of mortgage specialists unfortunately make fake pre-approvals because it doesn't pay them anything, right? Let's say I make a pre-approval. For me, it gives me absolutely nothing, right? Just like agents, I'm on commission based. I get paid once the mortgage funds, right? So what people do is they check the credit, they check everything and say on paper, okay, they write on their computer, the client is pre-approved, congratulations for this amount, and they send it to the client. And for the client, he receives that and says, okay, I guess this is good, and starts shopping. The problem is, if the credit center did not review the file, there might be surprises, right? Because we do what's called a soft check, right? So we see the basic debt of the customer, but when the credit department does it, they see a lot more details. So they might find, for example, that some kind of a monthly payments that we didn't notice, and the whole transaction can go bad because it's the credit department that has to make the final decision. So for me, I always send it to the credit department, because if they reviewed the whole file, afterwards they have no excuse to come back and say, okay, but we missed this, because they the ones who issued the pre-approval, not me from my Word document, right?
I see.
But unfortunately, not everyone does that way. Most people, to get rid of it, they just do it very fast and quick calculations, and good, you're pre-approved.
Yeah, because they're trying to make a sale at the end of the day, trying to get as many clients to move on with the transaction, and kind of playing a numbers game. In any profession, there's going to be people that are just doing what they have to do to try to make as much money as possible.
Yeah, they just want to get rid of the pre-approvals and focus on the actual live deals. But unfortunately for me, that's not how I see it. I see that every pre-approval is the beginning of a final transaction, right? So I make sure that to send everything to the credit department. This way I can, with confidence, tell the comment, okay, the credit department agreed with everything we discussed, and you're pre-approved for that amount.
Okay, well, that's good. It's good to know that we've got people that are credible in the game, that are doing it how it's supposed to be done. And plus, from an agent's perspective, having a client that has a fake pre-approval, going and shopping for something that he's not gonna qualify for at the end, is just such a big waste of time for the agent, for the mortgage broker that even spent that 10-15 minutes doing the calculation on paper, and then the seller and the seller's agent. Is just a bad deal overall. So since it is the first thing to do in the transaction, might as well do it well, so that you start off with as least friction possible in your transaction.
Absolutely. And another reason why people do those fake pre-approvals is because people contact them at the last second, right? Sometimes you get clients calling me and says, I'm making an offer tomorrow, can you get me pre-approved? The answer is no, because the credit department is not going to review it at night, right? The credit department needs 3, 4, 5 days to review the file entirely and make a real pre-approval. If you want an answer this quick, I can tell you over the phone, okay, from my calculations, this is how much you can get approved for, right? But that's my calculation. That's not an official pre-approval. But I declare that to the customer. If you want a real one, you have to be patient. You have to wait for it, right? If you just want to know of approximately, no problem. I can give you that over the phone, but not in writing.
I see what you're saying. Okay. Well, I want to cover another topic that I feel like is going to be pretty beneficial to listen to and to kind of, learn about for first-time home buyers.
Yeah.
You kind of hear it all over the place, the 5% down instead of the usual minimum 20%, because, usually in order to buy anything in real estate, there's a minimum of 20%.
Yeah.
Can you tell us a little bit more about what does it entail, that 5% down for the first property?
Yeah.
What are the qualifications? What's the portrait of a typical person that goes for that kind of financing for a deal?
Well, a big misconception that people have is that you have to be a first-time home buyer to put only 5%. The truth is, you can always put 5% down as long as it's your principal residence. So that's the property you're going to be living in, and it's not more than 2 units. So let's say you're buying a duplex that you're going to be living in one of the apartments, you can put down 5%. If you're buying a bungalow or a house that you're going to be living in it, 5%. Even if you're buying a cottage that you're going to be using to live in for your family, 5% if you want. You don't have to, it doesn't have to be your first property at all. The only time you have to put 20% is when it's an entirely rental property. So let's say you're buying, even if you're buying just a house, but you're telling the bank, you know what, I'm going to be renting that because it's going to be an investment property for me, you have to put 20%.
Okay, that's interesting. And that's a bit new to me. So would that mean that somebody could purchase a home as their own residence,
Yeah.
and then live in it for a set amount of time, and then leave that home, buy another one, and have that be their main residence as well, and just kind of benefit from the 5% over and over and over?
Yeah, absolutely. So you can do that, but you have to be careful, right? You have to make sure that you're buying it to live in it, right? So once I don't know, a year passes, it's your property. You can decide to rent it and go live somewhere else. For the bank, what's important, they want to know what are your plans at the moment of the purchase. Are you really planning to move in and live there? If the answer is yes, no problem, you can pay 5%. If you tell us that you're going to be living in it, but it turns out you're actually just renting it, that's a big problem. That's fraud, right? And for that, you can get it. They can take back the mortgage. They can, blacklist you. It's very, very bad to lie, right? But if you actually buy it, you live a certain amount of time, and then you get tired of that home and decide to move somewhere else, no problem, you can pay 5%.
Okay. So we can comfortably say that for somebody, kind of living in one home for 48 months, maybe 4 years, and then switching, would that make sense? Would 2 years make sense? In terms of the bank's perspective, I'm asking you this because you've worked in the finance industry for a long time, and I think maybe some people listening to this are going to be a bit confused in terms of, would the bank think that I'm frauding by leaving after 2 years or maybe leaving after 1 year?
There's no set time frame, but I would say if you're going to move within a year, it's going to ask questions.
It's going to be a bit.
There's no time frame. It's not written anywhere, right?
Yeah.
And again, maybe you're going to do it once, nobody's going to ask anything. But if you constantly do that, and the bank is going to notice that eventually after a few months you're moving somewhere else, it doesn't work that way, right? There's no time frame. I would say you have to at least live a year, for it to make sense, right? Nobody says I want to move in and live in my dream home and then live there for less than 12 months, right? In my opinion, that just doesn't happen. That means in the back of your head, you said, okay, I'm going to live there a few months just for the bank to not know, and then rent it, right? That's fraud. But if you live there a few years, it makes sense.
Okay, sounds good.
Or again, right? Something important to know, the bank is not stupid, right? Sometimes what clients do, they live in a mansion, and they tell us, I'm going to move in a 3.5 and live there, right? The bank is going to say that's not true, right? Nobody's going to move out from a big property to go live in a 3.5. We know that you're just saying that.
It's just an investment property, yeah.
Of course.
I see what you're saying.
So it has to be logical, right?
Okay. Back. Okay. So now, I wanted to kind of circle back to the initial topics in terms of now your final approval.
Yeah.
All right. So what would be the main reasons or a variety of reasons why somebody would fail to get that final approval in order to purchase their home?
Yeah. So let's start with the pre-approval. The main reason people don't get pre-approved is because they have too much debt. Okay, debt is the biggest issue for everyone. People don't realize, but their car payment, that's like $1,000 per month because you want a Mercedes, is gonna kill your mortgage. Because it's pretty much the same as a mortgage payment, right?
Yeah.
And although it's financing, even if it's financing, for us it's still monthly expenses every month that we have to consider in full, right? Credit card debt, that's a gigantic part. People have extreme amount of debt on their credit cards and think, oh, well, I'm just paying the minimum payment. Yes, but we don't take the minimum payment in consideration. We take 5% of the balance. That's gigantic, right? Lines of credit. So I think people have a student line of credit with like $30,000 in debt, right? That stuff, it doesn't go unnoticed, right? We have to put that in. And I would say that's the biggest issue on some people who even work and have everything good financially, just the amount of debt they build up can't get pre-approved or buy a home at all.
I just want to cut you, just slip something in. That's interesting to hear. I also heard that not having any debt is also kind of bad because you're not showing that you're able to handle your debt. So how much does that come into play compared to having too much debt? Where's the middle line? Where is it that you're kind of in the perfect spot?
So there's a difference between having debt and having credit. Okay, if you have, let's say, a credit card with even $10,000 limit, but you pay it off every month because, let's say, you spend $1,000 and you pay it off the same month, that's no problem. You have credit, but it's not debt because every month it's at zero, right? The issue, like you said, is let's say somebody has nothing. Okay, they have absolutely no credit cards, no lines of credit, nothing. They've never had credit in Canada. That's bad because we have no history of checking, does this person like pay on time, or that's why you have to go with the specialty programs like New to Canada and things like that. But yeah, if somebody just it also goes with the age, right? Let's say somebody's 20 and applying for a mortgage, and I can explain to my credit department, okay, well, this guy's just young, that's why he barely has any credit. If the person is 50 years old and has been living in Canada all his life and has absolutely no credit, there's going to be major questions of why, right? If you have a good explanation, I don't know, you say that you don't trust credit and you like to pay cash, it might pass, right? It has to be logical, then it really depends case by case. But if you can't really explain why you don't have it, it's going to be concerns. Right?
Actually, so would somebody, for example, me, I'm obviously looking to at some point in time invest, and hopefully earlier than later.
Yeah.
Let's say I were to invest next year, I would say that I've been handling credit for the past 3 years now.
Yeah.
So I've got 3 years worth of credit history. Everything's been paid off every month. Would 3 years be something that's credible, or would it still be something that you kind of have to explain to the bank? Maybe he's young, or
no. I think it would make sense, right? With your age, I would think 3 years of credit experience makes sense, and it shows again if you have even a credit card of $1,000 that you've always paid on time, it shows that you know how to handle credit, right? Of course, you have to go case by case. But for me, someone like your age who had credit for 3 years now and has no issues, and has no late payments, I would say there's no explanation to be had there.
Okay, that's good to hear, because most of the people that are watching this video or kind of following me are around my age, and most people are thinking about investing. Maybe if it's not now, it's later. It's a good idea to get a credit card. Absolutely. It's a good idea to use your credit card and use it responsibly and build your credit score. Absolutely. And build a certain history that whenever the bank goes and looks into it, kind of looks into who you are on a financial portrait.
Absolutely.
It's good, right?
Yeah, absolutely.
Okay. And is there anything else that you can add?
Yeah, so that was for the pre-approval, right?
Yeah.
On the final approval, the main reason people don't get their final approval is there's something wrong with the house, right? What people don't know is most of the time the bank has to send an appraiser in to look at the house condition, right? And there's two things that often happens. One, the client just overpays, so he pays more than the market. But that happens a lot right now, right? When there's 10 different offers. Let's see, the bank evaluates the home at $300,000, but the client paid $350,000, right? Well, the bank cannot give a mortgage for $350,000, right? They're going to say, okay, we're going to give you 95% or 80% of $300,000, and the rest the client has to pay themselves out of their pocket, right? Most of the time, the client doesn't have that money to cover the difference, and the sale falls apart, right? So you have to be careful of not overpaying. That's number one. Number two is there's just issues with the home itself. For example, the appraiser comes in, sees the foundation is going to fall apart. Well, the bank is not going to give you money for a property they're afraid is going to be crumbling time, right? And same thing if there's dangerous elements like vermiculite or asbestos. The bank is careful in that sense because it's dangerous for your health, and they don't want to necessarily lend you money on a property that can kill you over time, right? Yeah. So those are the things that you have to be careful. Is the appraisal is very important because the bank wants to make sure that the lien that they have on the property, that property is worth something, right? And it's worth enough to cover the mortgage and any expense that come with it.
So from what I'm understanding, a lot of times at the final approval, it can, it's things that are out of our control that drown the deal.
Absolutely.
Most of the time.
Yeah, most of the time. And sometimes there's ways around it, right? Let's say that, I don't know, there's problems with something construction-wise, right? Let's say there's foundation problems. Sometimes what we can do is we can say, okay, we can qualify you for more because the rest is going to be for a construction. So we say, okay, we're going to give you the mortgage, but you have to make sure, guaranteed that you're going to make those renovations to repair the house.
Okay.
So something like that can be done, right? It doesn't mean that because something's wrong, okay, the deal is done, right? There's other solutions. You have to go case by case. But sometimes, what happens, the bank will give you a bit more for renovations because they want to make sure that those essential renovations are done.
Okay. Well, I appreciate you mentioning all these things. I think that's going to help a lot of people out. I think we still have another 5 minutes.
Sure.
Now, we've talked about the beginning of a real estate transaction and getting a mortgage.
Yeah.
But now, let's say, for example, we've got somebody that's been in the house for the past 5 years,
Right.
10 years, or whatever it is, and has been paying their mortgage down.
Yeah.
Now, I think most people are familiar with the term of refinancing, but can you kind of give us an idea of what it is and in what ways can it be beneficial, and then maybe in what ways it couldn't?
Yeah. So there are many reasons people want to refinance. Usually the main one, people want to either purchase another property with the equity they've built up in the property, or they want to consolidate debt. I'll explain. So let's say you bought the house for $300,000, right? 5 years later, the market went up. Your house is now worth $500,000, right? That's an extreme comparison, but let's say what happens when you can refinance up to 80% of the new house value, okay? Which means that this is going to give you enough money to either, let's say you have a lot of debt that build up, you can just refinance your home and clear out all the debt you have, okay? This is called debt consolidation. So what happens is, let's say your rate for your mortgage is 2%, but it's a lot better than your credit card at 21% or your line of credit at 7%, right? So for people, it's very, very good because first off, instead of having 10 different credit cards to pay, they just pay the mortgage and that's it, right? And a way better interest rate.
Yeah, that makes a lot of sense.
So that's number one. Number two is, let's say people know they have about 100,000 in equity built up in their house. What they can do is they refinance, take it 100,000 and put it in as a down payment for a new property. It doesn't have to be a property you're going to be living in. It could be an investment property, right? That 100,000 might give you enough to put 20% on an investment property, because remember, if you're not living in it, you have to put minimum 20%. And then you build up. So again, you still live in that property, you refinance, and with that money, you buy an investment property.
So what's cool about that is, there's a lot of people that I feel like maybe have been building up equity through time, whether that's through their home's value kind of going up and them also paying down their mortgage.
Yeah.
So it's, they're gaining equity from both sides.
Absolutely.
There's a lot of normal, hardworking people that have normal day jobs that they can also become real estate investors through
Absolutely.
using their own equity as leverage to fund, other deals.
Yeah,
That's
absolutely.
correct?
Absolutely. It is correct. It helps with a down payment, absolutely. However, you have to be careful. You have to then qualify to have enough income to both pay off your home that you're currently living with, has a bigger mortgage now, right? And the investment property you're buying.
I see what
So
you're
if
saying.
you do qualify, absolutely, anyone can be an investor. However, you just have to be careful that you have enough, you generate enough income, or the property you're buying is generating enough income to cover the expenses.
Because now, in terms of refinancing, what's happening, and if you can correct me, obviously, if I'm wrong, is you're kind of getting a secondary mortgage that's covering the first one, and you're using the difference between that 300,000 and that 500,000, 80% of that difference to use as, like the down payment for a secondary.
Yeah, so it depends what kind of plan you have with your bank, but you can either close out the old mortgage you had and just have a bigger one, right? One big one. Or what happens is you can actually keep the one you already have, but have like an add-on that gives you access to a certain amount of credit if you need it. So I'll give you a quick explanation. Let's say you erase one and make a new one. That's a brand new mortgage, okay? But you can have what's called an equity plan, which means you keep a portion of what you already have, and the second portion is there as a line of credit. So you don't pay for it until you actually use it.
Is that the home equity line of credit, the HELOC?
Exactly. That's the HELOC. So basically what it does is, for now, if you're not using that money, you're just paying off your mortgage as you did before. Nothing changes, right? But you have access to that extra money if you do decide to invest or make renovations or whatever.
That's super interesting. Okay. Well, Evgueni, do you want to add anything else in terms of things that you would expect would be beneficial to anybody watching this? Any tips
Yeah.
and tricks?
Yeah, absolutely. Especially what's happening right now. Most people know that right now the interest rates are the lowest in Canada it's ever been in history, right?
Okay.
There's
Yeah.
not going to be a better time to buy right now than right now, but also there's not going to be a better time to refinance as right now. What's important is even if you don't have any plans to buy anything else or do whatever, what you can do sometimes is you can break the mortgage you currently have with your bank and take the same amount of mortgage but with a lower interest rate to save purely on the interest, right? Let's say somebody took a mortgage, I don't know, 3 years ago. The rate right now is probably on the mortgage you currently have is around 3.5%. Right now you can get a mortgage, I'm just giving an idea, let's say under 2%, right? Imagine the amount of money you save just from going 3.5% on your mortgage to 2%. It's incredible, right?
Definitely.
Yes, there's going to be a penalty from your bank, but sometimes it's worth it. That's why it's important to call us and say, okay, here's what I currently have, and do you think it's worth it to switch? I'll make the calculations for you. Maybe I'll say, you know what, your penalty is so big that it's not worth it, it's better to stay at your bank. But maybe I'll calculate and say, okay, even though you're going to pay, let's say, $3,000 of penalty right now, you're saving actually over your 4 years, let's say, $4,000 or $5,000. You see, so basically, you save $2,000 doing absolutely nothing, just switching banks.
Okay, that makes a lot of sense. So it's always a good idea to kind of look into it and see
Absolutely.
if maybe you can save some money, if you can have a better deal overall.
Yeah, sometimes people are afraid to talk, finance and mortgages. We don't bite, right? So call us, ask us how can we help. And most of the time, people are always shocked in a good way, because sometimes people call me and say, well, I can't afford, right? Anything. I'm like, yes, you can afford. Yes, maybe your budget is not $1 million, right? There's houses out there around Montreal. You instead of renting, right? You can own a little house in the suburbs, and your mortgage payment sometimes will be smaller than your rent payment downtown.
So you've got to look into it. You've got to contact my man Evgueni here.
Yes.
How can we reach you?
Yeah, so my link will be in the description, but you can either contact me by phone number. It's 514-909-1035.
Good man.
And you can also contact me by email or on all of my social media as well. But I think we can include the links in the description.
Definitely. All right, thank you for coming, man.
Thank you for having me.
Appreciate it.